In 2014, a French economist published a 700-page book filled with tax records and mortality tables. It became a global bestseller. Not because people love spreadsheets, because Thomas Piketty proved mathematically what everyone suspected but couldn't articulate. The system isn't broken. It's working exactly as designed. And that design has a formula, R greater than G. Welcome to Economic Historian, where money reveals what history hides. The question, why does wealth concentrate at the top in every capitalist economy, regardless of policy, regardless of technology, regardless of era? The common answer? Rich people work harder, or they're smarter, or they exploit workers, or governments enable them. Pick your ideology. Pick your villain. The uncomfortable truth, Piketty didn't blame individuals or governments. He blamed mathematics. Specifically, he blamed the relationship between two numbers that have governed wealth distribution for 3 centuries. R, the rate of return on capital. What your wealth earns when you already have wealth. Stocks, bonds, real estate, business ownership. The growth rate of money that doesn't require your labor. G, the rate of economic growth, the expansion of the overall economy. Wages, productivity, GDP, the growth rate of money that does require labor. For the past 300 years, with one brief exception, R has been greater than G. Returns on capital have outpaced economic growth. And when that happens, wealth doesn't just concentrate. It compounds. Exponentially. This isn't a political argument. It's a mathematical inevitability. Piketty spent 15 years analyzing tax records from 20 countries spanning 3 centuries. He tracked inheritance patterns, wealth distributions, and income data back to the French Revolution. And he found the same pattern over and over. When R exceeds G, those who own capital accumulate wealth faster than those who sell labor can ever catch up. The rich don't stay rich because they're better at making money. They stay rich because their money makes money faster than the economy grows. This is where the official story breaks down. We've been told that economic growth lifts all boats, that capitalism rewards productivity, that inequality is a bug in the system, not a feature. Piketty's data suggests something far more uncomfortable. Inequality isn't a failure of capitalism. It's the mathematical default state. To understand why this matters today and why it's about to accelerate, you have to understand how R greater than G actually operates across time. Here's the story we're told about wealth in capitalist economies. You work, you earn income. You save some, you invest. Your investments grow. If you're disciplined and smart, you build wealth over time. Anyone can do it. The system is fair because it's based on effort and choice. This narrative isn't entirely wrong. It's just incomplete because it ignores the starting position. And in a system where R greater than G, starting position is everything. Let's say the economy grows at 2% per year. That's G. Wages rise by 2%. GDP expands by 2%. The pie gets bigger, but capital returns, stocks, real estate, business ownership, historically average 4 to 5% annually. That's R. If you own capital, your wealth grows at 4 to 5% per year. If you only sell labor, your income grows at 2% per year. The gap is 2 to 3% annually. That doesn't sound like much, but compounding is a patient predator. Give it 30 years, and here's what happens. Someone who starts with $1 million in capital, earning 5% returns, ends with $4.3 million, even if they never work a day. Someone who starts with $0 and earns $50,000 annually with 2% wage growth ends with $1.5 million in savings if they save 20% of every paycheck for 30 years. The person who started with capital ends up with nearly 3 times more wealth than the person who saved aggressively their entire working life. Now scale that across generations. The person who inherited $1 million earns enough from returns to live comfortably without working. They reinvest the excess. Their children inherit $4 million. Their grandchildren inherit $17 million. The person who started with nothing saves heroically and leaves $1.5 million to their children, who then face the same equation. The gap doesn't close. It widens. Not because anyone is lazy or virtuous. Because our greater than G.Piketty found this pattern in every dataset he examined. France in 1810, Britain in 1870, America in 1930, Germany in 1950, Japan in 1990. The same mathematical relationship, the same divergence. This creates a specific incentive structure. And once you see it, you can't unsee it. If you own significant capital, your optimal strategy isn't to work harder. It's to preserve and compound what you have. You hire wealth managers. You optimize tax efficiency. You diversify across assets. You ensure R stays above G. If you don't own capital, your optimal strategy is to acquire it as fast as possible, because labor income alone will never catch up. You take risks, you start businesses, you buy property. You try to jump from the labor economy to the capital economy. But here's the trap. Most people can't make that jump. Because acquiring capital requires not spending income on consumption. And most labor income is already spoken for. Housing, food, healthcare, education. The median American household saves less than 5% of income. The top 10% saves 30 to 40%. Because they're more disciplined. Because their income exceeds their consumption needs by a wide enough margin to accumulate capital. The system doesn't reward effort. It rewards position. Piketty's data revealed something even more uncomfortable. Wealth concentration follows a predictable curve. In societies where R significantly exceeds G, the top 10% typically own 60 to 70% of all wealth. The top 1% owns 20 to 30%. The bottom 50% owns almost nothing. This wasn't true in all periods. Between 1930 and 1980, something unusual happened. Wealth concentration declined. The top 1% share of wealth fell. The middle class expanded. Why? 2 world wars destroyed massive amounts of capital. Governments imposed high taxes on wealth and inheritance. Economic growth rates were unusually high. G temporarily exceeded R, and labor had leveraged unions, full employment, political power. The Great Compression, economists call it. The era when R was less than G. But starting around 1980, the pattern reversed. Tax rates on capital fell. Globalization reduced labor's bargaining power. Growth rates slowed and are pulled away from G again. Wealth concentration resumed its historical trajectory. By 2010, the top 1% owned a larger share of wealth than at any point since 1909. This wasn't policy failure. It was mathematical reversion. Strip away the politics, and here's what Piketty's formula reveals. In any system where existing wealth generates returns higher than overall economic growth, inequality isn't a bug. It's the default state. The only thing that overrides are greater than. G is catastrophe or force, wars, revolutions, depression, or aggressive government intervention through taxation and redistribution. Without those shocks, wealth accumulates where wealth already exists. Not because the wealthy are evil, because math. Piketty didn't argue the rich were villains. He argued the system has a natural equilibrium, and that equilibrium is extreme concentration. The 20th century's middle-class prosperity wasn't capitalism working as intended. It was capitalism disrupted by unprecedented violence and political pressure. And as those disruptions fade into history, the system reverts to its mathematical mean. Nothing says free market quite like wealth compounding exclusively for those who already have it. The pattern didn't stop in 2014. It accelerated. Let's look at how our greater than G operates today, not in theory, but in specifics. The S&P 500 has averaged 10% annual returns over the past decade. Real estate in major metros has appreciated 7 to 12% annually. Private equity and venture capital have generated 15 to 25% returns for those with access. If you had $10 million in 2010 and simply matched market returns, you now have $26 million. You did nothing. You just owned assets while they appreciated. Median wage growth in the United States, 2 to 3% annually. Adjusted for inflation, real wage growth for most workers is closer to 0.5 to 1%. If you earned $50,000 in 2010 and received typical raises, you now earn $62,000. In real terms, your purchasing power barely moved. The gap is now 7 to 9% annually, or greater than G on steroids. Between 2020 and 2021, during a global pandemic and economic shutdown, U.S. billionaires increased their wealth by $1.8 trillion. Not because they worked harder during lockdown. Because asset prices exploded while the economy contracted. The Federal Reserve injected $4 trillion into financial markets. That money flowed to wherever capital already existed. Stock portfolios, real estate holdings, private equity funds. Workers got stimulus checks for $1,200. Capital owners got trillions in asset appreciation. R went parabolic. G went negative. In 1970, the median home cost 2.5 times the median household income. Today, it costs 6 to 8 times, depending on the market. If you bought a home in 2010, you've likely seen 80 to 150% appreciation. If you are trying to buy your first home now, you're competing against that accumulated capital. Homeownership, historically the primary wealth-building tool for the middle class, now requires capital to access. First-time buyers need parental help, inheritance, or prior asset sales. The wealth ladder just pulled up its bottom rung. Here's where it gets truly structural. The investments generating the highest returns, venture capital, private equity, hedge funds. Pre-EH funds legally require you to be an accredited investor. That means $1 million in assets or $200,000 in annual income. If you have wealth, you can access investments returning 15 to 25%. If you don't, you're limited to public markets returning 7 to 10%. The system formally restricts the highest returns to those who already have capital. Piketty's are greater than G isn't just descriptive. It's encoded in regulation. Today's economy has created 3 distinct tiers. Tier 1, capital owners. Wealth compounds through asset appreciation, dividend income, and business ownership. Effective growth rate, 8 to 15% annually. Tier 2, high-income labor. Doctors, lawyers, tech workers, earning enough to acquire capital. Can jump to Tier 1 over time. Growth rate, 3 to 5% annually. Tier 3, standard labor, service workers, retail, most employment. Income covers consumption, little left for capital acquisition. Growth rate, 0 to 2% annually. The tiers are separating, and the formula explains why. When asset prices rise faster than wages, the distance between tiers expands. You can't save your way from Tier 3 to Tier 1 when the assets you need to buy are appreciating faster than you can save. This isn't a conspiracy. It's compounding. Thomas Piketty's are greater than G reveals that wealth concentration isn't a political problem with a political solution. It's a mathematical problem with a mathematical outcome. When returns on existing capital exceed overall economic growth, wealth doesn't spread, it concentrates. The gap between those who own and those who work widens every year, compounding like interest. Our economy hasn't escaped this formula. We've supercharged it, lower taxes on capital gains than labor income. Monetary policy that inflates asset prices. Regulatory barriers that restrict high-return investments to the already wealthy. We didn't break the formula. We optimized for it. Understanding Piketty doesn't require accepting his proposed solutions: wealth taxes, higher inheritance taxes, global coordination. K. You can reject every policy recommendation, but you can't reject the mathematics. If R greater than GI wealth compounds where wealth already exists, if you want different outcomes, you need to change the formula. History offers exactly two proven methods: catastrophic destruction of capital or aggressive redistribution through taxation. Every other approach leaves the formula intact. You may not like those options, but Piketty's 3 centuries of data suggest those are the only options that actually change the trajectory. The rest is commentary. History doesn't repeat, but the mathematics do. And once you see the formula, every policy debate becomes a question. Does this raise G, lower R, or leave the compounding curve untouched? If this opened your eyes, subscribe now. The economy has a memory, and I'll help you understand it.